It's just like never.
I just, and so it was the time difference. And that's part of the reason you should be mistrusting of regression. You start a regression on Monday instead of a Friday, you can cover the same 2-year period. No. Oh, it's not a better, it's just less work, right? So think of, if you match the Bloomberg data, you're going to be within 0.01 of, we should be between 0.01 or 0.22. And the question you got to ask is, if that's what I'm gaining by running my own regression, because it is very difficult to mechanize it to the point where you can do it quickly. You got to download the prices, you got to bring especially the dividends. Yeah. Yeah, tell me how close you get. Okay, folks, welcome back for the second to last time. So next Monday is when everything comes due. And if you've signed up for the early final next Wednesday, you're going to have your early final. If not, your regular final is on, the 13th. So things are coming due. Please do remember to put your numbers into that Google shared spreadsheet by Sunday night. Because at some point in time, I've got a sheet, I have to download it. And please try to avoid doing things. I was looking at the master spreadsheet. I know you're doing it with the best of intentions. You're putting 2 stars next to your number and putting in a comment. You have an entire project report to tell me why your beta might need this. Just enter the number, because otherwise I have to go in and remove those because Excel, when I downloaded Excel, I need to do computations with the numbers you sent me. And if you put in something that makes it difficult, it's just an extra layer. So I know you care a lot about me. So even if you don't, try to avoid putting things in there. Yeah.
Cash flow.
Yeah.
And it's like in the periods.
So basically, I don't know, it's because I gave you freedom. You look at the last 3 years, last 5 years, whatever period you picked, give me the aggregated number or an average number. I just want to get a sense of, does your company pay out less or more? So I'm going to leave that choice up to you as to how, because some of you don't have a choice. You have a company that's been around only 3 years. That's why I did not want to put in over the last 5 years, because then the 3-year people can say, what do I do now? So whatever you picked as your time period, tell me what your cumulative or average dividends were, average free cash or equity, so I can get a sense again. I'm just trying to get a sense across your companies. Are your companies more likely to hold back cash, pay out everything, or pay out more than they do? And that's what you're going to see on Monday, is what your companies look like. So today I'm going to complete the discussion of valuation. And as I said, you will know enough valuation by the end of this class that you don't have to take a valuation class. I'm not trying to talk you out of my valuation class. The rest is all practice. So you can think of the whole class as icing on the cake if you can get the basics nailed down. So as you remember, we talked about how critical it is when you value a company that you connect your story to numbers. That a valuation without a story is just a collection of numbers. So tell a story and be okay being uncomfortable telling the story, because part of you is going to say, but I don't know. You will never know, right? Your story is going to keep changing. You notice the Amazon earnings report came out after close of trading yesterday? What is the big news story there? If you are going to take something that affects valuation, what was it in that earnings report that would lead you to retell a different story for Amazon? Anybody? I know you're busy. You probably didn't even know that Amazon came. So I know you have a lot on your plate. Guillermo? They did mention that they're starting to see revenues from the AI space for the first time. I'm not going to get overexcited, But yesterday I was at Dartmouth giving a talk about AI. I'll put it on YouTube so you can see the entire session if you want. And I was thinking, the Clayton Christensen argument for disruption. Is anybody aware of what Clayton Christensen's views on disruption were, Kierman? Or basically, what was his view about how disruption happens or in any business? Who creates it? Yes. It's always from below, but who are the disruptors? People who have a lot to lose or people who have nothing to lose? Usually it's not even inferior. Small startups, companies with no legacy are the ones who are most likely to disrupt because they don't have to worry about if I do this. I mean, in 1997, at Stern, every MBA class was required to actually take a company. There was this, they called it a capstone project. It was just another hurdle that you had to jump through to get your certificate. And the company that used to provide the information was Barnes & Noble. At that time, incredibly successful. And I remember every semester we'd have to, MBA sort of talk about how glorious Barnes & Noble was, how amazing it was, what great strategy it has. And while it was being disrupted from below by Amazon. And the question then afterwards was, why didn't Barnes & Noble do something to stop Amazon? What's the answer to that? Why didn't they go into online book? Because remember, Amazon started off as an online book retailer. Barnes & Noble could have stomped on them and kind of created their own. Why didn't they do it? Yes. It's not even sunk costs. You bring up online book retailing. You know what remember this is a company built around traditional bookstores, right? They're getting their cash flows and earnings from those bookstores. So you suggest, let's start an online book rate. The traditional bookstores, people there, but that will cannibalize our sales, which is true, right? So each store will have less sales if people are buying online. This is the legacy problem, which is if there's disruption, the legacy players wait too long because they have too much to lose. And the question I was raising is, will AI be different? Because there are two ingredients that came together for AI. ChatGPT might have been that moment where we all became aware of AI, but there have been two forces over the last 15 years leading up to that moment. One was the collection of data. And I'm not just talking about financial data, but data about our personal choices and lives that companies were collecting. And how did they get the data? Because we gave it to them. So don't complain about privacy because we did a quid quo pro. I'll give you my data. You give me free GPS. I'll give you my data. Essentially, there's an old saying in Silicon Valley, if you don't know what the product is, you're the product. Basically, it's a collection of big data. And the other is the buildup of computing power, right? Which has been building up more powerful chips. Big data plus big computing power is what creates AI, because fundamentally, what does AI do? It goes in and trawls through the data. And today I saw a news story that the traditional newspapers are suing ChatGPT. This is going to become a more and more prevalent phenomenon because ChatGPT is not some magical device. It's just this collective computing power that goes through every news story about something and essentially channels it. So the question is, if you're going to build an AI product, you need big data and computing power. And who has the biggest advantage on those two dimensions? The big tech companies, right? The Googles and the Amazons, which are collecting the data every day. So they're not just big data, they have exclusive data. Google and Amazon know more about you than you think they know. And if you have Alexa in your home, I don't even want to tell you what data Amazon, I am terrified of what Amazon knows about me. I have Alexa, Google, and Siri. And sometimes I tell Siri to tell Google to tell Alexa. It actually works, try it out. Now, Siri, tell Google to tell Alexa, and you see this transmission through the house. Big data and computing power. So this is going to be different from the previous disruptions, in my view, where the disruptors are not going to be young startups, because how does a young startup get the computing power and the data it might actually cut, which is actually bad news if you're wringing your hands about how the Mag 7 or the FANGAM have dominated equities. You might have to get ready for another decade of domination. So the story for me for the Amazon is if AI is starting to make its presence felt, that's going to add an entire new layer to the Amazon story. Yeah. So what I'm trying to say is, and I got distracted, is you start a story and then of course you get an earnings report and your entire story changes. Get ready for change. So I'm going to start this class with pure mechanics, and the mechanics are going to be familiar because we've already encountered them earlier in the class. So first thing you need when you value a company is cash flows. Let's look at the different definitions of cash flows. You can have dividends. Why would you use them? Either because you're incredibly lazy and you don't want to do any work because you can get it right out, or because you have this view, which some value investors do, of this is the only cash flow I ever get. Everything else is you compute in a paper, free cash flows. Who knows when I'll get that? But that's the simplest and easiest measure. But as you saw in the section on dividends, in the US at least, increasingly cash is being returned in the form of buybacks. So it's one step up. Rather than just focus on dividends, you can look at dividends plus buybacks, which is, I call augmented dividends, because now when you do that, though, remember to look across time because buybacks are lumpy. They come in big amounts in some years. And of course, if you truly want to get away from what companies actually do, you can look at free cash flow equity. Zach?
Again, why, like conceptually, what the thought is.
Well, the dividends themselves are what you've got as a fixed payment. Buybacks just augment that cash flow, right? So if you think about cash flows returned to shareholders, I think of buybacks as augmenting traditional dividends, right? Because collectively, that is the cash returned. So, I mean, I could have called it anything. I could have called cash return to equity investors. Now, augmented dividend stays with the framework of the dividend discount model, but says, look, instead of dividends, I'm going to use this consolidated number that reflects not just dividends, plus stock buybacks as well, right? And of course, in the dividend section, we talked about just not looking at what companies do and looking at what they could have paid out, which is free cash flow equity. Those are all cash flows to equity investors, but three variations on it. They're all equity cash flows. The alternative, I said, is to look at the entire business, look at the collective cash flow all claim holders in the business have, and that's free cash flow to the firm. Yesterday, as I was at Dartmouth, one of the questions I asked, what is the free cash flow to Amazon? And I said, could you please restate that question because I cannot answer the question. Because what's missing in that question? And I said, what is the free cash flow to the firm? What's missing in that question? Free cash flow to whom? To equity or firm, right? Because unless you specified, I'm 3/4 of the way through. I have no idea what you're asking me for. Free cash flow to equity is after debt payments. Free cash flow to the firm is pre-debt because debt holders are no longer viewed as outsiders. They're brought into the company. So to compute free cash flow to the firm, instead of starting with net income, you start with after-tax operating income. You see why? Because net income is after interest expenses. You climb the income statement. You look at what the operating income is. You look at what taxes you would have paid on that operating income. It's not the actual taxes you're paying. And then you subtract out what you reinvest, which in the case, as in the free cash flow to equity, is net capex minus depreciation, and change in working capital. That's a total reinvestment. So those are the four variations of cash flows you're going to see. I'm going to use three of those variations for my companies. In 2008, when I valued Deutsche Bank, I still operate in the illusion that banks were run by sensible people and that the regulation worked. And that Deutsche was here to stay as a long-standing, well-run bank. I know there are all these delusions that I've lost over time, but that was 2008. And remember, if you can trust banks to be run by sensible people and you can trust regulators, then what happens? Dividends become a measure of what they should have paid out. That's a sensible management part. And you can discount dividends. And in 2008, I'm going to use dividends and value dividends. By 2016, I'd lost that delusion of Deutsche being a well-run bank. They were paying no dividends. They had negative cash flows. So I switched to free cash flow equity. And if you remember, the version of free cash flow equity I have for banks is I start with the net income and I subtract out what you have to invest in your regulatory capital to survive and grow. So you're going to see both versions for Deutsche. For Tata Motors, I'm just going to go with free cash flow equity. It's a family group company. I can't trust the dividends. They could be higher, lower. So here I've estimated the free cash flow equity each year. And the reason the years are overlapping is that fiscal year is not calendar year end. So basically that's why it goes 2008, 2009. Each year I start with a net income. Good years and bad years. Then some years they actually start with a loss. Then I have CapEx, which is a negative cash flow, depreciation, which is a positive cash flow. That difference between CapEx and depreciation is the net CapEx. Then I've change in working capital. Take a look at the change in working capital. It's all over the place. It increases, it decreases. That's why you got to be very careful when you compute free cash flows to equity or the firm, not to take the most recent year and make that the base for everything you do, because who knows what the most recent year brought. But because it's free cash flow to equity, I also have to bring the change in debt. During this period, each year debt increased. For free cash flow to equity, that's actually a good thing, right? Because when debt increases, remember, cash comes into the company, debt decreases, it goes out. So my equity reinvestment is just CapEx minus depreciation plus change in working capital. That's a total reinvestment. And if you have debt coming through, that debt is paying for some of the reinvestment. I'm going to net it out. So there's my equity reinvestment. And as with the working capital, it goes all over the place. Big amounts in some year, small amounts in others. And that's again a reason when you look at the reinvestment from last year, you shouldn't freak out. You can have negative reinvestment in a given year if a company doesn't reinvest that year. So if I look at the aggregated values during this period, Tata Motors reinvested 88% of its net income back into the business. For the moment, just file that away. So that's an equity reinvestment rate. We'll come back and talk about why that matters when you value the company. But in terms of mechanics, I want to make sure everybody gets a sense of these are both cash flows to equity. One, I'm just taking what they pay out, dividends. And in the other, I'm estimating what they could have paid out. Yes, Arina. It should be CapEx minus depreciation plus change in working capital. Because remember, when working capital goes up, it's a reinvestment minus the change in debt because debt pays for some of it. So the debt becomes actually, you benefit from borrowing money as an equity investor because they take some of the burden off your shoulders. Yes, Zach.
I think I missed something when you said these are both, you said both, like as we're talking about multiple things, are we just talking about free cash flow to equity or are there?
They're both dividends and free, because with Deutsche, there were dividends. They're both measures of cash flows to equity. One, you're trusting the managers to pay out what they can. The other, you're saying, I don't trust you guys. I'm going to estimate what you could have paid out.
So
Yeah.
that's your dividends and free cash.
That's why free cash flow to equity, one way to think of it is potential dividend. That's what they could have paid.
That's why we were talking about augmented dividends.
Exactly.
On the buybacks. Okay.
Yeah. So one way to think about buybacks is if your free cash flow to equity is higher than the dividend, you let it accumulate for a while. You begin to get a big cash balance, use it to buy back stock. So free cash flows to equity are what are funding both dividends and buybacks. No.
Are we or does it matter at all that the mechanics of dividends versus buybacks? Like as in a dividend, it's a passive thing, an investor.
Not from the company's perspective, right? From the investor's perspective, it might matter in good ways or bad ways, right? Because with dividends, everybody gets it. With buybacks, only those people who sell shares get it. But from the company's viewpoint, think about what happens. Cash leaves the company either way, right? The effect is exactly the same for both.
Because we're looking at it from the company's perspective.
Because here we're asking what's the value of the business. So from that perspective, that's why it matters. Now, if you look at free cash flow to the firm, it's in my view, a simpler calculation. So first you climb the income statement. Everybody clear on why we do it? Because that's something I see people messing up all the time. Start with the operating income. Why operating income? Because below that, all kinds of crap comes in that you don't want in your cash flow. You got interest expenses, you got interest income, you got income from cross holdings. There's a mess down here. So I climb to the operating income. I mean, I use the word earnings before interest and taxes and operating income interchangeably. If you're taking Dan's class, he'd probably freak out saying that's not right, Dan Godet. But no, in my perspective, in the larger scheme of things, we're we're nitpicking when you talk about from a valuation perspective. So I'm going to stick with those terms as interchangeable. So in this case, my operating income was 10.032 billion. And remember, this was in 2013 when accountants weren't capitalizing leases, so I capitalized the lease. This is the adjusted operating income. Their effective tax rate was 31%. Somebody remind me again what an effective tax rate is and how we compute it. It's you go in the income statement, it's accrual taxes paid divided by accrual taxable income. I use the word accrual because these are not cash taxes and cash income. So all you need so you look in the income statement. So even if a company doesn't tell you what their effective tax rate is, you can compute it. It's taxes divided by taxable income, and then 31%. CapEx was 5,239 million. Depreciation amortization was 2,192 million. So the net CapEx was about 3 billion. What did they invest in? Theme parks, infrastructure, the Burbank headquarters, and all kinds of things go into that mix. Change in non-cash working capital. First, working capital increase. Remind me again, when you have an increase in working capital, does that reduce your cash flows or increase your cash flows? It reduces the cash flows. Intuitively, why does that happen? Why does having more inventory hurt your cash flows? I'm sorry. You're buying stuff all the time. It's not the buying of the stuff, it's a holding on to the stuff, right? So when it sits on your shelves, it's tying up cash. So if I look at my free cash flow of the firm, I start with the 10,032 million, which is my operating income. I act like, and I repeat the word, I act like I pay taxes on that entire operating income. Why is that act? I mean, what's the big item I get to subtract from it before I actually pay taxes? Akash? No, depreciation is EBIT is already after depreciation. When we get to taxable income, there's one big item that I subtract out before I actually pay taxes. It's interest expenses, right? We made a big deal about how interest expenses are tax deductible, and I seem to be acting like, ignore it. So how would I defend that? Because it seems like I'm missing a big tax savings. You have a lot of debt. Why am I not bringing the tax savings into my?
Because it's free cash flow to the firm and not to the equity.
But give me the intuitive explanation. That tax benefit is still there, right? If I'm not counting it in my cash flows, and I'm going to lead you actually to the answer, I have to be counting it somewhere else. Where else can I count it? What do I discount these cash flows back at? Free cash flow of the firm? Because they're to the entire firm. At the cost of capital, right? What goes into cost of capital? Cost of equity and after that is where I capture the tax benefit. And if you bring that same tax benefit into the cash flows, you've double counted it. In 1 in 5 discounted cash flow valuations, tax benefits get double counted. Here's why. People start with the EBIT, the right thing to do, and they subtract out the actual taxes paid instead of this hypothetical tax. You've double counted the tax benefit. So that's why you've got to compute that after tax as if you paid taxes. Then I subtract out net capex. I know you're supposed to add capex and net. I'll tell you why I prefer to treat it as a net item. Capex and depreciation are locked at the hip. Do you see why? What do I get to depreciate? Whatever I capex. If I make them 2 line items, I open the possibility that I forget that they're connected. And I let one item grow at a higher rate than the other. And if that item is depreciation, God help me, because sooner or later, what's going to happen? My depreciation is going to exceed my capex and keep growing. Now I'm in fairy tale land, because now you're depreciating things that are not there. So the net capex, which is 3,629 million. I subtract the change in working capital. And remember, I'm completely agnostic about whether it's going to be positive or negative. So let the cash flows tell you whether they're increasing. In this case, they decrease my free cash flow. But if working capital had decreased, I'll get a boon from working capital, which pushes up my free cash flow to the firm. My free cash flow to the firm for Disney is 3,188 million. Now I'm going to calculate one other thing again, which right now you're saying, why waste the time? It's going to come in useful later. If I take my reinvestment, which is the 3,629 plus 103, 3,732 million, and divide it by my operating income, after-tax operating income, I come up with what I call a reinvestment rate, 54%. Remember for Tata Motors, we estimated 88% of the net income gets reinvested by equity investors into the company. The analogous number here with free cash flow to the firm is Disney reinvests about 54% of its after-tax operating income back into the business. Why do I care? For the cash flows, you're saying, I have the cash flows already. Why are you wasting your time with this extra? What comes after cash flows? You got discount rates and then you have growth, right? Do you think knowing how much a company reinvests back into the business is a critical ingredient in estimating growth? It better be, because growth doesn't appear magically. It's not a number on a spreadsheet that I can hike up. This is going to become ammunition I can use to determine how quickly I can grow. So any questions on cash flows? So these same versions we saw when we did capital budgeting. When I did the Disney theme park, I estimated free cash flow to the firm, to the theme park. When you did your case, the Costco case, you estimated free cash flow to the firm on the case, pre-debt. When I did the Vale iron ore mining project, I looked at free cash flow to equity. So not inventing a new term, we're just estimating in the context of an entire company. So let's move on to the second ingredient. We've got the cash flows nailed down, at least a sense of it. Zach?
Would you say is the key difference when we had free cash flow to equity and free cash flow to firm from the firm's perspective when you're looking at the two?
One is before, it's just one is before that, the other is after that. That's the only thing, right? Okay. So, but I'm glad you asked the question. Can a company have positive free cash flows of firm and negative free cash flow to equity? Let me reframe the question. What kinds of companies can end up with big positive free cash flows of firm and negative free cash flow to equity? Highly levered companies. So one of the problems with focusing on free cash flow of the firm is you might be completely missing the fact that this company is on the verge of disaster because it can't make its debt payments. And while you're mapping out your pathway to nirvana, which is terminal value, distress gets in the way, right? So I actually think it's useful, even if you don't do free cash flow of the firm, to just take a look at free cash flow equity, see if your company is healthy on both aspects. Let's move on to discount rates. Are discount rates a key part of DCF? What do you think, Airman? There's a D in the DCF. Of course they are. Okay. But I want to kind of walk that back. Discount rates matter, but not as much as you think they do. Now, I'll give you a very good measure of whether you have a healthy valuation. Keep tabs on how much time you spend thinking about the discount rate and how much time you spend thinking about cash flows. If you're spending more than 10 or 15% of the time in evaluation thinking about discount rates, you've lost the script. Discount rates matter. They have to be consistent. What does that mean? You tell me how you estimate cash flows, I'll tell you how to get the discount rate. If your cash flows are before debt cash flows, then the discount rate has to be a cost of capital. If they're after debt, they have to be a cost of equity. If your cash flows are in Turkish lira, your discount rate better be in Turkish lira. Your valuation is just going to blow up. So currency, cash flows. So never ever respond to a question, what discount rate should I use? Unless you've looked at the cash flows, they have to be consistent. So we're going to talk about the same cost of equity and cost of capital we've talked about all through this class from the perspective of valuation. So let's start with Deutsche Bank's cost of equity in 2008. In 2008, the beta that I estimated for Deutsche Bank using a bottom-up approach, I broke them down into commercial banking and investment banking, was 1.16. The euro risk-free rate then was 4%. So this was a pre-crisis. So rates 2008 obviously took a hit to those rates. 4% risk-free rate. And the equity risk premium that I estimated for Deutsche then was 4.5%. Risk-free rate plus beta. So by now, you've done that so many times, it should become, you don't have to look at the notes to do this. Risk-free rate plus beta times risk premium. With Tata Motors in 2013, I chose to estimate my risk-free rate in rupees because I chose to do the valuation in rupees. Could I value Tata Motors in dollars? Yeah, they actually have an ADR. So if I said, look, I'm interested in the ADR, I'd like to do everything in dollars. All it means is my growth rates, my cash flows, my discount rate will have to be in dollars. In rupees, my risk-free rate is 6.57%. I know it's been a really long time, but do you remember how I got that risk-free rate? What did I start with? The Indian government bond rate, which was 8.82%. And then what did I do? Subtracted out the default spread, which was for India. So let's be specific. You have company and country default spreads floating around. I subtract out the country default spread of 2.25%. There's my risk-free rate, 6.57%. Plus 0.964. This is actually the bottom-up beta. So you can see the culmination of all those numbers in corporate finance helping you out while you value the companies, bottom-up beta for Tata Motors, based on automobile companies globally and Tata Motors tax rate and debt to equity ratio. And the equity risk premium of 7.19%. Is that the Indian equity risk premium? It's a weighted average equity risk premium, right? It's based on where Tata Motors gets its revenues. And the acquisition of Jaguar Land Rover brought in this chunk of foreign revenues. That equity risk premium now, for Tata Motors, if you did the valuation now, is about 35% India, 65% the rest of the world. Jaguar Land Rover has grown disproportionately relative to Tata Motors, and it's become a less Indian company, at least. So don't get your patriotic fervor up. It's okay. It is still in India, but it is a global company that happens to be incorporated in India. So I've got a cost of equity. And for Disney, I'm going to compute a cost of capital. Why? Because I'm going to do the valuation of the firm at the firm level, not at the equity level. This page actually is the fourth time you've seen this page. I know you don't remember the previous 3 times. The first time I showed it to you was at the end of the cost of capital discussion, where I tortured you with risk-free rates and betas and equity risk premiums. In the end, I said, this is where we were leading, the hurdle rate. The second time you saw it was at the start of the capital structure section. And I said, this is the starting point. And this is what, it could be at different debt ratios. I am actually using Tata Motors' actual debt ratio to compute the cost of capital. As opposed to what a lot of evaluations that analysts do. What do they use instead of the actual debt ratio? They use a target debt ratio. And my response is, who are you to set the debt ratio? It's not your firm. You can't go around replacing the actual debt ratio with the target just because you feel it's more appropriate. It's different if you're doing an acquisition. Say, I am going to run the company. Don't go around replacing what's there with what you think should be there. You're not Bob Iger. And even Bob Iger probably doesn't have the power to change it that quickly. So to start the process, I am going to leave the debt ratio at what it is. And the cost of capital I end up with is the same cost of capital of 7.81% we used as a hurdle rate in our investment analysis. And the same cost of capital that we did as a starting point for, is there a different mix of debt and equity for the firm? But because I've done that optimal capital structure, I know they have excess debt capacity if they choose to use it. And that might come into play when I do the valuation. And here's one place where when you compute cost of capital for a company, you might want to think differently than cost of capital for a project. When I did the Disney theme park project, I computed a cost of capital. I let it stay the same all through because it's the same project. But remember what I said about companies? And this is in response to Zach's question about the difference. It's actually a good way to think about what's different about valuing a project versus valuing a company. A company is a portfolio of projects. A portfolio of projects can shift over time, right? You get new projects, you take away old projects, which is a fancy way of saying you start with a cost of capital of 7.81%, but that could change over time and probably will, depending on the story you tell for the company. Let's say your Disney stories, they're going to become all streaming in 10 years. You're going to get a very different beta and cost of capital than if your stories are going to get rid of streaming and become all theme park. They're both plausible stories. And in this case, I start with the 7.81% cost of capital. And over time, that cost of capital drifts down to 7 point, not a huge change, You think that was such a waste of time, but if you did a young company, what's your cost of capital going to look like right now for Reddit? High or low? Probably high. And in your spreadsheet, what are you doing to Reddit? Making it a big profitable company, right? That's what your spreadsheet tells me. And you got to stay consistent with the story you're telling. If that is the case, your cost of capital should go down over time. I have never understood DCFs of young companies where the cost of capital is nailed down up front. It's left at 15% all the way through. And your spreadsheet, that young company becomes an old company. And a profitable company, the cost of capital stays at 15%. I've never used a small cap premium in my lifetime, and I hope never to touch it. And here's one reason why you should be very wary about, the small cap premium is. It's a number you add on to the cost of cap equity of small companies because they're small. Already, you can see there is not much below it in terms of economic interest. Small, I'll add an extra 4%. Every appraiser that I know does this. And it's okay. Even if you believe there's a small cap premium, and incidentally, there hasn't been one since 1981, but let's say you continue with that belief. Tell me what you're doing to your small company over the next 10 years on your spreadsheet. And the answer is small companies become big if you put in a 20% growth rate and say, even if you believe there's a small cap premium, shouldn't it go away by the time you get to year 10? I think it's actually internally inconsistent to get to terminal value. Tell me your company is going to grow at 3% a year forever and continue with the cost of capital that includes a small cap premium. So we got cash flows, we got discount rates. And so far we are on familiar ground because we have somebody to blame, right? If you ask me why the cash flows, that's what the accountants said. When I ask you, why is your discount rate? Well, I can't mess with the T-bond rate. Damodaran gave me the equity risk premium. I'm always a convenient target to blame. The beta could be wrong, but it's a beta. But now you got to take ownership of evaluation. Because the third input you have to come up with is a growth rate for your company. So let's step back. When you think about estimating growth for your company, where are you going to start? You can look at the past, obviously, to begin with, right? It's, you have a history, and you have a history of a company like Unilever, which is a dead man walking, 1% growth over time. If you put in a 10% growth rate, you better give me a compelling story about what's going to change at the company. If you're looking at a company that's coming in with a 30% growth rate and you give me a high growth rate, now I can see maybe an extension, but you start with the past growth rate. Start, don't end there. That shouldn't be the only driver of future growth. Second, you can make the mistake of asking managers what they think about the future. I should take that back. Managers do have some information, but you got to dig. There's a great book by Nate Silver called The Signal in the Noise. And management throws a lot of noise at you, but embedded in that noise, there might be some information. So in all that stuff management throws, through that, you might be able to extract information about future growth, what their plans are. And third, you can look at what the company is doing. You can look at history, you can outsource analysts, managers, or you can look at fundamentals. What are fundamentals? Remember I computed that reinvestment rate? Hold all else constant. You have two companies. One is reinvesting very little. The reinvestment rate is only 10%. The other is reinvesting 60%. Which one would you expect to grow at a higher rate in the future? The higher reinvestment, right? Of course, it doesn't necessarily have to create value. The more you reinvest, I mean, obviously there are exceptions. The second thing, though, is it doesn't matter what you reinvest in. It's an absurd question. It doesn't matter whether you invest in good projects or bad projects. Absolutely, right? I've got to bring in not just how much you're reinvesting, but what you're reinvesting in. How well are you reinvesting? That's what we mean by fundamentals. I can create equations for this, but those are intuitive questions. So when you look at a company with stable margins, the operating margin is pretty stable, and stable returns on capital, the growth rate actually becomes a very simple number to estimate. You tell me your reinvestment rate and you tell me your return on capital, I can estimate the growth rate. So I'm going to this is called sustainable growth. It is a powerful equation, but it's a very limited equation. It works only if your margins are stable. So if you're looking at earnings per share, like a dividend discount, I'll say, how quickly can I grow? I'm going to look at your retention ratio, which is whatever you're not paying out. I'm going to look at your return on equity, and the product of those two numbers will become your growth in earnings per share. Engineers, quantitative people love these equations because this makes it look like you don't have to estimate growth. Just take the retention ratio times return on equity. I'm done. We'll talk about the reason you got to be cautious, but that gives. If you're looking at net income from non-cash assets, you can use the equity reinvestment rate as your measure of how much you're reinvesting. And you can look at the return on equity on your non-cash assets. You're saying, how would I compute it? How do we normally compute return on equity? We take net income, we divide by book equity, right? That looks at the total return equity. But let's suppose I asked you, what is the return on equity you're earning on your non-cash assets? Justin, what would I do to my net income if I want just the non-cash assets? So what did I have to do? I'd have to take the interest income out of my net income, right? Because that's, and then in my book equity, I'm going to take out the cash portion of that book equity. Remember, the cash is in there as well. That gives me a non-cash return on equity. Equity reinvestment rate times non-cash return equity gives me the growth in non-cash net income. And if you ask me for growth in operating income, if margins are stable, and again, that's key here, I take the return on capital. It's the same return on capital you did in section 5 of the project, so you don't have to go reinvent it. And I multiply it by that retention ratio, and I get an expected growth rate in operating income. These are powerful equations. Put them in your back pocket, because even if you decide not to use them for the next 5 or 10 years, they will come into play when you compute that big terminal value at the end. So applying this to Deutsche in 2007, the return equity was 19.45%. In hindsight, we know that this was because banks were playing games with regulatory capital, taking risks that they should not. It eventually caught up with them, but in that moment of delusion where I thought that banks were run by sensible people, the regulatory framework worked, their return equity is 19.45%. Their retention ratio was 67%. They retained 2/3 of their net income. The product of those two numbers would give me a growth rate of 13%. And even in 2008, I was skeptical. I said, look, the 19% looks really high, and it looks like they're retaining a lot. And whenever you have that doubt, there is an easy fix for it, right? If you think the last year is a strange year, just do the common sense thing. Look at averages across time. And the average return on equity they had over the 5-year period reading into 2008 was a lower number, 11.8%. And their average retention ratio was also a lower number, 46%. And in my 2008 valuation, the growth I gave them in earnings per share was 5.4%. Even that was hopelessly optimistic in hindsight. But at least I was trying. I was trying to normalize. But I guess I should have normalized for the overreach management was making. But I did not see it until it was too late. And for Tata Motors, with the 88% retention ratio and the return on equity of 43%, and sometimes you just got to hold your nose and use these numbers. Do I really think that Tata Motors is earning a 43% return equity? I don't think so. This is an accounting number. Who knows what they've done to the book equity, right? But if you trust those numbers, the growth you come up with is absurdly high. Here's something to remember. When you get a number that you look at and say, that doesn't make sense for this company, it's your valuation. If you put that growth rate and say, I had no choice, my response is, what do you mean you had no choice? You entered the number. I'll give you a chance to override the number. There's nothing in valuation that should be on autopilot. I can give you neat little equations, but they're not replacing your mind. And thank God for that. Because if it were this neat and this easy, I just don't need you, right? All I need is an Excel spreadsheet and something to feed it in. And if you just are the mechanism to take the number and feed it in, that is a really low bar to set for yourself if this is what I'm bringing to the valuation. So you can use the sustainable growth equation to get a sense of the number, but ultimately it is your number. This is why on my Excel spreadsheet, I constantly every step say, Do you want to change these numbers? Because I want to give you as many chances as I can to say that number doesn't make sense. You can just override, let the defaults play through. I will value your company. You get an absurd number. And then if you ask me, why am I getting an absurd number? I say, I gave you 7 chances to change the inputs. You took none of them. This is exactly what comes out of it. That's what I mean by taking ownership of evaluation. My model doesn't value a company. You do. My model is just a tool which you can adapt and modify. And finally, when you think about return equity, there is this ingredient return equity that we need to think about. There are 2 ways a company can get a high return equity. One is to take great projects. Okay, Google, Facebook, Apple, no matter what you think about the accounting, their return equity is high. Whether it's as high as the book value, I don't think so, but it's high. How do we know? We can see their competitive advantages. We can see what they do. We can see their barriers to entry. But return equity can also be high because you borrowed a lot of money. Do you see how borrowing can pump up your return equity? When you borrow money, you pay an after-tax cost of debt. In today's environment, that number is going to be 4, 5%, even if you have a high cost of debt. If you make more than that on your projects, let's say you make 15% on your projects, that difference comes to you as the equity investor. So when you look at a high return equity, it might make sense to decompose it to ask, where is it coming from? So I took I've taken 2 companies here, but one has a return capital of 20%. The second has a return capital of 12%. The first company uses no debt. So its return equity is also 20%. The second company uses 100% debt to equity ratio. For every dollar of equity, they have $100 of debt. And it borrows money at 4%. Its return equity is also going to be 20%. You say, how do I tell the 2 apart? Let me ask you a question. If I gave you these 2 companies as an equity investor and they traded at the same PE or price per share, which one would you rather buy? The 20% return equity company that came from great projects, or the 20% return equity company that came from using a lot of debt? Great projects, right? And how in evaluation do we capture that? Anybody? When we value equity, what do we use as a discount rate? Cost of equity. What goes into a cost of equity? A risk-free rate, an equity risk premium, and a beta, right? I've led you to the destination. Finish it off for me. That beta is what? A levered beta. If these 2 companies are in the same business, the first company is going to have a much lower beta and cost of equity than the second. And that's going to take care of it. But if you're careless, use regression betas and just use the same beta for every company, these companies are going to look. The next time you see equity research analysts compare PE ratios across companies, check to see if they're making sure that they're controlling for leverage across these companies. Otherwise, their cheapest companies might be just basket cases waiting to go bankrupt because they have so much debt. And finally, for Disney, I took their reinvestment rate, which I showed you 54%. The return on capital, remember we did this very early in the class to compute the excess return was 12.61%. And if I assume that those numbers can be sustained in the future, and that's key. If I assume that, their expected growth rate will be the product of those 2 numbers, which is 6.8%. So in a world where you trust accountants and margins are stable, you can just use the sustainable growth equation. Unfortunately, that's not the world you and I live in, right? Most of your companies, you can look at that number and say, I don't want to make my growth rate this automated number. And the good news is you can override it. The bad news is you now have to fill in the story for me. So I'll give you the more generic way of estimating cash flows, at least in the near term. And this is what my spreadsheet is built under. So if you built around, so if you've looked at my spreadsheet, this should give you a sense of, because you're going to get to those insights. How do I estimate those? I'm going to start with revenues. Why? Because margins can change over time. And I'm going to project out growth in revenues. That growth can be high, it can be low, it can be 0, or it can be negative, right? Depending on the business you're in. Second stop, I'm going to ask you what will happen to margins over time. Those margins can increase. And if you have negative margins, you hope and pray they will increase. Otherwise, your value is going to be negative. Okay? If you have positive margins which are high, you're saying what's competition looking like? Margins can decrease or margins can stay pretty stable. You have revenues, you have margins. Revenue times margin gives me operating income. And if you give me the tax rate, I can compute after-tax operating income. And what do I need to net from that to get to free cash flow? I need to net out net capex, change in working capital. Collectively, that number is known as reinvestment. And here, to estimate the reinvestment, I'm going to link it to revenues. You see why I need to link it to revenues? Because your margins are changing. It's revenues that are determining how much you reinvest. Because you can increase income effortlessly by changing margins, but to increase revenues, you got to reinvest. And to do that, I'm going to use a ratio of sales to invested capital. You're saying, what does that tell me? It tells me how efficiently you can deliver growth. If you can deliver growth efficiently, that number is going to be a high number. For every dollar you reinvest, you get $5 in revenues. Kudos to you. The typical US company gets about $1.50 in revenues per dollar. If it takes you, for every dollar you invest, you get only 50 cents in revenues. You have to work really hard to grow. So and I'm effectively holding you accountable. You want to put a high growth rate in revenues, I understand. But here's what you need to reinvest, and the sales to capital ratio gives me that collective reinvestment. Notice I'm aggregating all of those numbers, capex, depreciation, working capital, into a reinvestment. Why? Why break it out? What's the point if you don't have some secret information that tells you what capex is going to do? And I've never had secret information to do it. So I'm going to undercut everything in my own book of that detailed free cash flow and say, just consolidate the damn thing, forecast the total number, because you can capture acquisitions, R&D, everything in that consolidated number. So what I'd like to do is give you at least some sense when you sit down with your company. So this is just about, and so now I want you to start thinking about your company as I go through the things you will think about. Do I give my company a high revenue growth rate or a low revenue growth rate? So let's start with revenue growth. You're trying to value a company. Clearly, it has a product or service, which is part of a bigger market. You want to look at how big that market is, holding all else constant. If you're in a nice big market, you have more room to grow than if you're, there your story might come into play. If you're looking at a Turkish company that plans to just be Turkish, the kind of revenue growth rate you can give them will be lower than if it's a Turkish company that plans to go across Europe, expand geographically. You control the narrative. The total market is going to be determined by not just geography, but by what kind of products and services you can offer. Second, that market itself could be growing. It's nice to be not just in a big market, but a big market that is growing. Why? Because it gives you slack, right? Because you can then grow with the market. Now, do you see why China 20 years ago was such an attractive market for so many investors? It was a huge market. It was growing 10% a year. India right now is beckoning the same way. AI right now is beckoning for the same reasons. Big market growing. So that's the tantalizing vision, right? But you have to, just having a big market that's growing doesn't make you a valuable company. You got to claw your way. And I use the word intentionally, claw your way, because everybody's coming after this market. And you got to tell me what your market share is. And here, if you have a high market share already, that kind of crimps how much you can grow, right? Having a high market share in a mature market means that you can't grow very much. Where's the growth going to come from? So if you're in a market that's growing only 3% a year, you have 70% market share, we say, look, and I can put in a 5% growth. And you're going to complain. You say, that's a low growth rate for me, but you kind of, you know, where's the additional growth going to come from? Conversely, if you have a low market share, you have more room to grow. It might require that you cut prices and go. So you're going to look at the total market, you're going to look at your market share. And I'm going to introduce a buzzword. I'm not big on buzzwords, but you got to think about what kind of business am I in? What do the industry economics look like? Saying, what does that mean? Essentially, I want to know, once this market hits steady state, will there be 2 or 3 players dominating the market? Will there be 25? It's a big question, right? Because it'll tell you what market share you can get. 20 years ago, if you looked at the advertising market, biggest player might have been the New York Times. You know what the market share was of total advertising? Probably 3%. Why were they capped at 3%? Because you had a language issue, the global advertising market, and people were reading in different languages. You had a geography issue. People in LA wanted the LA Times. It was a splintered market. So if you valued the New York Times in 2005 and you looked at market share, giving them a 5% market share would have been an optimistic number. And over the last decade, what's happened to the advertising market? Today, 65% of all advertising happens where? Online. And if you look at the online advertising market, who are the two biggest online players? Google and Facebook. Not only do they have 65% of the market, they actually continue to increase their market share rather than decrease it. It's a winner-take-all business, and it's become a winner-take-all business, which has implications, right? You value a company in a winner-take-all business. First, you got to make a judgment on, will my company be one of the winners? And if the answer is no, you're already kind of doomed to a low growth rate and low market share. Or will my company have a chance of being one of the winners? When I valued Zomato, the Indian food delivery company, the big market that's growing, the Indian food delivery market. That is one part of my story. And the other part of my story is this is going to be a winner-take-all market because restaurants want to go where the customers are. So you don't want to go to some upstart. So at the end of the game, there are going to be 2 or 3 players. I don't know who they are. And in my story, Zomato was one of those 3 winners. I could be completely wrong about that. But you're looking at what are the economics of this market. And finally, you're playing in a game where there are other players here. You have to look at what are my strengths as a company as opposed to everybody else. I'm trying to dampen the enthusiasm people often have when they value companies in big markets, saying, it's a big market, my company has to grow. There is no such thing as has to grow. So you're looking at those factors. So any questions on revenue growth? Because I've given you things to think about when you think about revenue growth for your company. You know, think about the market, how much it's growing, your market share. Let's move on to operating margins. Now, if I asked you as a founder or the owner of a company, do you like high margins or low margins? Stupid question, right? Everybody wants high margins. So as you sit there to value a company, especially if it's a young company which is losing money right now. It's a company with a long and established history of margins, Coca-Cola. You have lots to go on, right? But let's say you're looking at a young company, it doesn't have any history, and you're saying, should I give this company a high margin or low margin? Let's look at what goes into that judgment. The first is unit economics. What does that mean? When this company sells an extra unit, how much does it cost the company to make that extra unit? So let's say you decide to subscribe to Adobe Creative Cloud. Remember, right now, for instance, you can't buy Acrobat and Dreamweaver. You have to subscribe. It's a subscription model. You go onto the Adobe website, you subscribe to Creative Cloud. NYU pays for my Creative Cloud, but you probably have to pay for yours. No, it's expensive, like $180. So they collect $180 of your money. How much does it cost them to make that extra copy of Creative Cloud for you? Absolutely nothing. You just download it off their site. The unit economics for Adobe are amazing. So you know what that means, right? When you look at Adobe's margins in steady state, they can be 30, and this is why SaaS companies and software companies and intermediaries can end up, it's not because they're great companies, but because the unit economics works in their favor. And to just show you why understanding your company can give you different unit economics, I'm going to give you 2 streaming companies, Spotify and Netflix. Both stream, right? There are lots of subscribers. One streams music and podcasts, the other streams movies and visual content. They go out and they sign subscribers, but they were going to have very different margins in steady state. And here's why. When Netflix, how many of you are Netflix subscribers? So this is why Netflix, in fact, when you're estimating growth for Netflix, remember how many hands went up here? Your growth is kind of capped because the only way they can make more money is by making your right hand pay for a subscription and say, use the remote with your right hand. You're now using your left hand. You have to pay a second subscription. It's only a matter of time. You're in a living room that's different from your bedroom, another subscription model. But this is, there's a cap here. So when you value Netflix, you're not going to put 30% growth. Have you noticed that Netflix just announced that they're not going to announce how many subscribers they have anymore? Sometimes the things companies announce, we talked about signaling. What are they signaling? Our subscribers are not growing that much, so we're going to stop reporting them. Very convenient, guys. But I can adjust for it. You don't have to tell me. I now will put a low growth on subscribers in because you're not telling me. But Netflix, when you think about why you have Netflix, it is for the content. A lot of crappy content, but a lot of content, right? Every day, you know, we turn on Netflix and just do it. Now, how many new shows do you add today? 137. So, you know, it comes in. But that content is produced by Netflix. They pay for the content, which means that when they add an extra subscriber, there is no incremental content that they make just for you. So the potential margins will reflect that. In contrast, you know how Spotify pays for content? Justin, do you have Spotify? No. Guillermo, do you have Spotify? Who's your favorite artist? George Strait. So let's suppose you get on and you listen to George Strait. You listen. How does Spotify pay for that content? Every time Guillermo listens to George Strait, they have to pay George Strait. It's based on how many times people listen to music. You see what this, when you're valuing Spotify, why this is going to have implications, right? When Spotify signs a new subscriber, that subscriber comes with costs. If that person listens to Taylor Swift all day long, he can wipe out whatever subscription revenue you get, because that's why Spotify, they automatic, if they keep checking, are you still around? Are you, because they're afraid that you will turn Spotify on, forget it, and play 24 hours, and they're paying people who, you know, for songs that nobody's listening to. Very different business models. And what that'll mean is when you value Spotify, you got to be very careful about pushing the margins to 35 or 40%, because unless they change their content model, they can't get there. The content costs alone at Spotify amount to 80% of their revenues, and it becomes a variable cost. As their revenues go up, that cost goes up as well. So unit economics. The second is economies of scale. We love to use this because it's such a great buzzword for when you want to increase margins. There are economies of scale. First, when you talk about economies of scale, they apply more if you're a small company rather than a big company, right? So if you're valuing GM, and you increase the margins, don't even say the words economies of scale. It has to be a small company that's growing, and it's gaining because your costs are fixed, and you know. And if you want to make the case for economies of scale, and I say, show me some evidence of economies of scale, what would you show me as evidence if you wanted to claim economies of scale in your company? What do you have to show? What happens to economies of scale? As revenues grow, your costs grow at a lower rate, right? So I remember in 2019, I was going to be on CNBC, and I knew economies of scale would come up. Somebody said there were economies of scale at Uber when it was going public. So what I did was I graphed out the revenues for Uber over their entire lifetime. I took every cost item and I graphed it out. And you guess what I found? Each cost item was growing faster than revenues, every single one of them. Don't even talk about economies of scale because the numbers are pushing in the opposite direction. So rather than just leave it as a buzzword, you have Capital IQ, download the data, see if in fact, which line items have economies of scale and which line items don't. It's a great exercise in understanding business economics. And finally, of course, competition matters. Why? Because what's the margin? Price minus cost, right? So even if your costs stay fixed, if competition comes in and price gets pushed down, your margins will go down. You see, that's a lot to think about. It's a nature of valuation. You got to think about a lot of stuff, and at the end, you got to make a decision on what the margin is. So let's say your margin right now is 5%. You tell me it's going to go to 15%. You give me a convincing story of why. And I'm going to ask you how quickly. The spreadsheet is going to ask you, when do you want me to move it? Okay. So what will go into decision as to whether you can move to the margin quickly or whether you should take more time? One is, if you're starting at minus 25%, I guarantee you're not getting to 15% in 2 years, right? There's a lot of work to do. So common sense, the lower your margin is right now relative to your target, the more time you should get. The second is how the business is behaving. Margins don't magically turn positive. Companies have to work to make themselves more profitable. I still remember my turning point in Uber was for the longest time, my reaction to the company was this company is great at scaling up. They have no idea how to make money. My turning point was the day Dara Kostrowski, I was talking to, he called a Uber employee conference. Of course, it leaked on Twitter, where he told told employees, guys, we've got to figure out a way to make money. And I got down and I said, thank you, God. Finally, after 10 years, somebody at the company recognizes that having more riders is not the end game. Yeah, you got to figure out how to make money. With Paytm, and I valued them, and our Indian payment processing companies, I thought at some point in time, somebody in the company would get down there and say, we need to make money. Never happened. That company is going to zero, and the sooner it gets to zero, the better, right? If you're running a company that can scale up, can't figure out a way to make money. So what's the business doing? And finally, some business models create margins faster than others. So you're going to need to look at what is the company doing? How is it growing? To get a sense of when the margins will improve. So revenue growth margins, let's talk about reinvestment. And this is the trickiest of the numbers simply because most of us have no perspective on it. You know what I mean by that? If I ask you to use an 80% return on capital, you say that's a high number. Why? Because in your mind, at least, it's 15% is, you can compare to the cost of capital, industry averages. If I ask you to use a sales to capital ratio of 2.5, be honest. You say, is that a high number? Is that a low number? Is that, I mean, I've been computing sales to capital ratios for 15 years. If you ask me, what's a typical sales to capital ratio? I'll struggle because it is a number that doesn't come easily in terms of a frame. So as you look at this number, here's what I want you to think about. One is look at the company's history, right? And remember, what you're looking at is the incremental sales to capital ratio. What I mean by that is the change in revenues from year to year and the change in invested capital from year to year. Maybe it's companies improving, maybe it's decreasing. So look at the trend lines. And as you look at making that forecast for your company, there are three things I want you to think about. The first is, will this company be able to reinvest more efficiently, less efficiently, or about as efficiently as it scales up? If you're a retailer, there's almost no benefit to scaling up in terms of reinvestment. Why? Because you have to keep opening new stores. Each store is going to essentially have to generate its own revenues. But if you're a manufacturing company or a distribution company, there might be a benefit to scaling up. So your sales to capital ratio can get higher so remember, the higher the sales to capital ratio becomes, the more efficiently you're generating growth as the company scales up. If your company already has excess capacity, it's built a lot of capacity, that gives you slack, right? I will give you a classic example. Novo Nordisk is going to be able to grow almost effortlessly for the next 5 years. Why? Where's all their growth coming from? Ozempic and Wegovy, right? It's done. They've done the hard work. Pharmaceutical companies, you can coast on big blockbuster drugs. So if your company has done something that's going to allow it to grow for the next 5 years, you essentially can use a much higher sale. So that's why in the spreadsheet, I give you two chances, right? Once, give me the sales to capital ratio for the first 5 years and then beyond, because if you have excess capacity, you're going to show it. And finally, in some companies, and this is a Novo Nordisk example again, there is a lag between when you invest and when you grow. R&D is what created Wegovy and Ozempic. That R&D happened, 15 years ago. So if you're looking at a company where there's a big lag, you might be able to grow for the next decade based on things you did a decade ago. So that's all going to come in to the estimate of whether you want to use a high number or a low number. So here's an example. I took Baidu, the search engine company. There's my revenue growth. And in my story, I assumed that they would stay a search engine in China. You say, why don't you let them go global? I don't think they have a shot at being a global search engine going against, Bing or forget about Google, basically against the existing search engine. So, but it's still a big market, but it's a market that is scaling down. So as you see over time, I have to factor that in. I'm going to let them, I'm going to have the high revenue growth. And at the time I did this in 2013, China was still a high growth market. If I were valuing Baidu now, I've got to lower the growth rates because the market itself is growing slower. Second, over time, I'm assuming that the margins, which right now are sky high. Why are online, why are search engine company margins so high? What are the unit economics for Google? How do they make money? You basically, if your company is found through the Google search engine, you got to pay Google a certain amount of money. Cost them nothing. But over time, I do think that Baidu's margins will come down, not because Google is going to come into China, but because Tencent and JD and Alibaba are going to figure their own way of drawing people in. They're big tech companies. So in my story, I do think that the margins will decrease over time. You say, how do you know? I don't. This is my story, right? So if you have a different story, just replace the margins. I don't own the high ground on this story. And finally, in the reinvestment, I did assume that they would because they had a history that I could look at of sales reinvestment of about $2.64 of revenues for every dollar of capital. I assumed that they would continue to do it. As revenue growth gives me revenues, margins give me the operating income. The tax rate over time, I did assume would move towards the marginal tax rate. This is, again, one of the few places in finance where we use the effective tax rate. Up till now, everything we've done has been marginal tax rate driven, right? Cost of debt, cost of capital. Here we use the effective tax rate for the earnings at least, because for the near term, you might benefit from deferring taxes. Eventually, though, I assume it catches up with you. The tax rate moves over time. Valuation should be dynamic. No input should remain where it is without you at least thinking about will it change over time. And my free cash flow as a firm reflect my story. That sales to capital ratio, the way I get the reinvestment is you take the change in revenues, divide by it's as simple as that. Take the change in revenues, divide by sales to capital, you get the reinvestment each year. My story eventually shows up as free cash flow as a firm. And that free cash flow, which brings me to the elephant in the room, which is no matter what company you're valuing, a large chunk of your value will come from the terminal value. And let's be clear why we need a terminal value. We need it because without it, you're going to be estimating cash flows forever. So you put closure with the terminal value. And that terminal value, at least in an intrinsic valuation, is estimated by assuming your company will grow at a constant rate forever. I've described this equation before as the most used and most misused equation in finance because you can do some real damage by using it badly. So let's think about what it is you're trying to do in terminal value and why, and what you can do to keep it from running away with the evaluation, because you can do all this hard work of estimating growth and margins and reinvestment and get to year 10 and do weird stuff with your terminal value and cause your valuation to blow up. So I'm going to send you the links to this, but about 10 years ago, I wrote a series of 5 posts on terminal value where I dealt with what I called misconceptions about terminal value that I saw among appraisers. So I'm going to summarize those 5 posts because they capture ways in which you can put guardrails on your terminal value. First, we're told that, when I say we're told, that we're told by people like me writing books that the only way you can get a terminal value is to put that cash flow divided by R minus G, a perpetual growth model. If that's a message you got from my book, I'm sorry, because it's not the only way. You get to year 10 for a company. Let's say you don't think your company can last forever. Why? Because it's got a key person. When the person dies, you think the company will die with it. Can you, for your terminal value, assume your cash flows continue for 20 years after year 10 and then end? Absolutely. When I valued Aramco, I did not use a perpetual growth model. I used a 50-year life. And in the 50 years, guess what I did? I extracted all the oil out of the Saudi sands. And then I said, at the end of 50 years, you got sand. Nobody wants sand. There is no terminal value. So there are companies. So you might say, look, I'm going to have a finite growth period after this. Use a 20-year growing annuity, make that your terminal value. Second, and this, I still get at least 3 or 4 emails from people saying, I use this perpetual growth model and I'm getting a negative value. And it's a money-making company. And here's what happens. You take the free cash flow in the numerator. You have R minus G in the denominator. Let's play a game. Let's suppose your R, the discount rate is 8%, and your G is 2%. If you keep the cash flows fixed and you go from 2 to 3, what will happen to your terminal value? It's going to get higher, right? 3 to 4 gets even higher. You can't stop yourself. This is so exciting. You're adding value right there. Billions. You make 4 to 5, even higher. 5 to 6. 6 to 7. In fact, the increases are getting larger. You think this is amazing. And you go 7 to 8. You got what I call Buzz Lightyear valuations. You got infinity and beyond, right? And this happens all the time when you play with the growth rate. And the word is play. Remember, this model can be used only if your growth rate is a growth rate you can sustain forever. It has to come with a cap. And if you obey the cap, that the cap rate cannot exceed the growth rate of the economy, you will never have this problem of terminal value blowing up on you. So to discipline myself, and this is a rule that I built in the spreadsheet as well, I cap that growth rate at the risk-free rate. If that sounds familiar, that's what I did when I did the implied equity. It's something I've done all through this class. Think of your risk-free rate as a cap. So when people complain about the 4.5% T-bond rate, and compared to the 1.5% T-bond rate 3 years ago, see, that's terrible. Remember, it does come with this capacity now that you can now use a 4% growth rate and get away with it, where you could not do that 3 years ago. Third, you'd be told that the growth rate is the biggest driver of your terminal value. And it looks mathematically like it is. It change G, and what's missing there is when you change the growth rate in a business, and we've talked about this already, what has to happen to the reinvestment? It has to go up. And how much will it have to go up? It depends on what kind of returns on capital you make on that reinvestment. Let me cut to the chase. If you grow by reinvesting and earning a return on capital equal to the cost of capital, as you change the growth, and you can try this if you want, your terminal value will remain unchanged. Why? Because when you earn the return on capital equal to the cost of capital, you're taking 0 net present value projects. Remember what we said about net present value? When you take a project with a net present value, it adds to your value. If you take a 0 net present value project, how much does it add to the value? 0. What about 100 projects with a 0? 100 times, this is great. 1,000 times 0 is 0. You can grow as much as you want, but if you earn the big assumption in your terminal value calculation is what you tell me about your return on capital, not now, but 10 years from now. Which is going to depend on your story, right? Does my company have competitive advantages that are going to fade away? Or are my company's competitive advantages much more long-standing? A Coca-Cola brand name is one of the most enduring competitive advantages of all time. You might say, I'm going to let the return capital be higher than the cost of capital. You're valuing a steel or an automobile company. Where's the excess returns going to come from? This is this business. We struggle to earn more. The other thing about terminal value calculations, you need that growth rate in perpetuity. So the last week I was talking to a bunch of appraisers, many in their 50s and 60s. Been valuing companies all their lives. And they were showing the effects of that life. So I asked them, have you ever valued a company where in your terminal value calculation, you've set your growth rate at below 0? Not one person in the room. And collectively, they'd probably done thousands. So every company you value, you get to year 10 and you put in a 2% growth rate in perpetuity. Do you see why that number might have, I mean, if you're valuing a tobacco company or even a fossil fuel company, can an argument be made that when you get to year 10, your growth rate in perpetuity should be minus 3% a year forever? I can make a good argument for it. And if that's the case, your cash flows or your revenues will peak in year 10, and then they will decline, which is the way most company life cycles are, right? Every company doesn't become this huge monstrosity. So leave open the possibility that for your company, the growth rate in perpetuity can actually be less than 0. And finally, I've heard people complain, but the terminal value is such a high percentage of the value today. And mathematically, that'll always be the case. It can be 80% of the value. My response is, so what? When you buy stock, assuming you buy the right stock or the right equity, how do you make money? Or when do you make money? You don't make it while you hold the stock. You might collect this tiny dividend. You make it when you sell the stock from the price appreciation. Guess what? Terminal value holds up a mirror to how we make money in equities. So as you look at terminal value, don't fall into that trap of thinking in rigid terms, be flexible. So I'm going to close today's class with a valuation of Vale. It's very messy, so don't know. I used a stable growth model. So let me first back up and explain why I gave it stable growth. Vale is an iron ore mining company. It's not just an iron ore, it's the largest iron ore mining company in the world. Now, is the iron ore market growing, shrinking? And even if you don't have a good sense of the market, what kind of market do you think it is? It's definitely not an AI kind of market, right? Maybe not tobacco either. It's not decline. So best case, you're probably looking at what grow at the inflation rate, and it's a commodity company, so mature company. To value it as a mature company, I had to be careful. If I took the last year's numbers, remember commodity companies, even if they're mature, numbers can jump around. I average things out. So basically, I'm using a mature company model using an average. I'll call it normalized, but basically it's an average number over time. So when you look at the numbers here, I've looked at 5 years of return on capital, 5 years of tax rates. Everything reflects the fact that I'm kind of cleaning up for the fact that year to year there's volatility. So if you look at the actual valuation, you look at the 17,626 million, that is the average operating income over the previous 5 years, not the current year. And my justification is iron ore prices go up and down. I want to bring that in. The tax rate of 20.92% is the average effective tax rate over 5 years, reflecting the fact tax rates jump around. And for the reinvestment rate, I just looked at their return on capital, again, based on normalized numbers. Their normalized return on capital is 17.25%. If I expect them to grow 2% a year in perpetuity, and in terminal value calculations, that sustainable growth equation comes in, they'll need to reinvest about 11.59%. I am assuming that they can earn more than their cost of capital for a really, really long time. Why? Let's say iron ore prices go up. It's not like new competition can pop up, right? What are you going to do? Go look for iron ore in your backyard? You can try, but I don't think there's much there. The people who own the reserves effectively have a complete buried entry, and Vale does. So this valuation that you see at 202.8 billion is basically the value that I got from a DCF model. The value per share that I came up with was $32. The stock was trading at $13.57, and I'll finish the story. If I believe this valuation, what should I do? Buy, and I did. Worst mistake of my life. Okay. I bought it for 3 reasons. I said, I have 3 things going for me. Commodity prices look like they've bottomed out. Currency is, the Ria has been weak over the last, but that should end. And in terms of political risk, there's been a lot of turmoil in Brazil, but it can't get any worse, can it? And this is like asking the gods to deliver a message to you. And they did. Over the next year, the stock went to 7. I sold the stock. Incidentally, I wrote a post called No Mas, No Mas. And the Brazilian response I got was, that's Spanish, that's not Portuguese. And they say, you're missing the point here, which is I give up, I give up. So if you get a chance, read that, because that's the aftermath of this valuation. So when we, on Monday, I'm going to summarize this, and I'm going to, there's a few more pages in this that I'll come back and use in my closing presentation. But I will see you on Monday, and please work on your project.